Um, all right. So first, I always like to kick it off, just introing for me and the objective of the roundtable and this company as a whole. And um, so, first of all, the roundtable, I started doing this a couple months ago. I do it very sporadically. It's more about, when I can um, allow, when I have time to be able to do it. And so the the objective of it though is to really to help people make connections. And one of the things that I'm reminded of is whenever I worked in real estate over at Human Free Apartment Locators, whenever I first got started in '06. One of the great benefits of sitting in a 5x5 cubicle for many hours every single day was that you get to learn off of the people around you, and you get the benefit of being around others who are trying different things and learning different things, and you hear cooler talk, and there's a lot that you can actually grow together by being in that type of work environment. Well, now we're post COVID, and also this is a virtual company, so we don't really have that benefit as much anymore. And so this roundtable is more just to open it up, bring in guest speakers, and also I like to share the vision of the company and me as a broker personally, because my wife was shutting the door because I'm being too loud. Sorry. And so I really like to share a personal message, because Spirit Real Estate is more than just me being a designated broker. I have, extremely low rates, and that's because it's not about making the money. It's about helping you guys achieve success through real estate and giving y'all all the tools that I wasn't able to have. And so with that being said, we are a faith-based company. And so I was reading this morning, and I was really trying to think about, okay, what can I bring to this roundtable that'll be, a message from my heart about, how we can be better stewards of the gifts that we're given by God. And one of the things that I'm reminded of is that whenever I send out a welcome email, and in that email, at the bottom of it, I always put the golden rule, which I don't know if y'all know, but it is from the Bible. Matthew 7:12, it says, "So in everything, do to others what you would have them do to you." And that everything it's not loosely translated. It means everything in your work, at home, whenever you're playing a sport, whenever you're doing any type of activity, you would want to do to others as you would have them do to you. And what that means is treat people with love and kindness the way that you would want to be treated. And that means in more detail about
tell me to.
Like, it's a little bit easier to say that whenever you're talking about friends or family. Hey guys, if y'all could
No, but the information is
here, let's just mute everybody. Here we go. All right. So it's easy to, being loving and kind to your friends or your family members, or maybe even your clients who are really nice to you. But occasionally we're going to be dealing with clients or other realtors or property managers or people that are not kind, that they're not nice, and their objective is mostly self-centered, and they want to cheat the system in some cases, and they don't really care what it costs you. And the Bible actually tells us to love them just as much as we love those who are kind to us. And it even goes to as far as to say, to turn the other cheek, to give them your cloak. I mean, there's a lot that goes into loving your enemy. And the one thing in Luke 6:32, it says, for love those who love you. For if you love those who love you, what credit is that to you? Even sinners loved those who love them. And I was like, well, sinners, I mean, I'm a sinner. We're all sinners. Everybody's sinned and fallen short of the glory of God. And so I was like, I wonder what that means in the Greek. And so I actually looked it up, and I'm not even going to try to pronounce that, but it's a set apart person. It's someone they're not free from sin. We as Christians are free from sin through Christ. These that they're talking about are preeminently sinful, especially wicked. So we're even called to love them as well, because that's what sets us apart. That's what makes us the light to the world. And there's actually 4 verses in the Bible that talk about being the light in the world, us being the light. I mean, the light is referenced many, many more times in different respects, but these 4 verses specifically talk about you and the light. And so in Matthew 5:13, this one's the one that most people are familiar with, which is, you are the light of the world. A city set on a hill cannot be hidden, nor does a lamp get put under a basket. There was even a song written about this particular verse, but it's saying, being a light to those who are around you and not shying away from it. So, step into the light that's been given to you. And John 8:12 talks about how the light is actually a gift from God. It's not something that we necessarily are doing or being. It's actually within us, and it's choosing to let that work through us. And then the light can actually protect you. One of the reasons why I'm so outspoken about being a Christian and this being a faith-based company is that I want, I have no desires of becoming some mega brokerage where we have thousands and thousands of people, because the idea is, if I am outspoken about this, the people who don't associate with this, who are actually like, ooh, gross Christians, I don't want to deal with that, they will have no interest in working for me. And I am perfectly fine with that, because this particular company, we're going to be helping each other grow and helping each other be a light within the world. And so finally, in Ephesians, if we walk in the light, if we choose to be that light, then our fruit will be apparent through goodness and righteousness and truth. And think of how good of an agent you would be. I mean, as a real estate agent, our job is a service industry type job. We are customer service oriented. Everything that we do is for our clients. All of our regulations are to protect our clients. And so with that in mind, if our fruit is being good, being right, and everything that we say is truth, then that means that our clients are going to be able to really benefit from us choosing to be that light in this world. So, all right, well, that was, what I wanted to share. I'm going to go ahead and hand it over to Anthony Bashton, who's from Prime Residential Mortgage. Anthony, why don't you jump in here? Anthony, you there?
Hello.
Yep, I got you.
Can you hear me, Brian?
I can hear you. Anthony, why don't you
Good
go ahead and
morning.
introduce yourself?
Hi there. Let's see. Will it allow me to turn on my screen? Let's see here. So, can you guys see my screen? Hello, hello.
Yes, sir.
Can you guys see my screen?
Yes, we can see it.
Okay. All right, let me tell you guys a little bit about myself. My name's Anthony. I've been in the mortgage industry for a little over 20 years. I'm a branch manager for Primary Residential Mortgage Group. I'm located in DFW. I'm licensed in 5 states right now: Texas, Tennessee, New Mexico, Ohio, and Pennsylvania is the next state that we should have added here in just a little bit. Primary, as a company, they do business in 50 states. So I have the option to take and have my branch license so I can service your customers even if they're moving out of state. If you do have someone that you've serviced in the past and you know they're going to be leaving, I would encourage you to let me help them. I have a team. I have 2 full-time loan officer assistants. I have one. Hold on. Sorry about that. I needed to turn my phone off. It was starting to ring. Just a little bit more about myself. So I look forward to working with you guys. I've been working with Brian, I think, for going on about 3 years now.
That sounds all right.
Yeah. We've closed several deals together. Some of them have been very easy ones, and some of them have been ones that you're like, cross your fingers and let's hope this gets closed. I've got a lot of experience. I just did a pre-call for one of Brian's agents yesterday for Sherry, and her customer had a little bit of a uniqueness to her. She had only been self-employed for a year, but because it was related to the field that she's in, that she just got it, her bar, she just passed her bar. After getting everything with underwriting, we were able to use that self-employment income, even though she's only been doing it for a year, because under the guidelines, since she was W-2'd as an attorney, it was considered a relationship with the job that she was currently doing, and she had just been licensed, which a lot of places would have looked at her tax returns and told you, we can't do anything until we have a second year. So I encourage you to send me anything that you've got a question on, or because I always tell you, let me take a look. Only thing I can do is come back and say, hey, we've got to do this or do that. I'm very bottom lines with things. I'll look at something, I'm going to let you know. I'm never going to just tell you we can't do it. I'll always give you a suggestion on how we can move forward. I'm going to run through this PowerPoint a little bit just to tell you a little bit more about myself, and then we can go over any questions that you guys might have. So over here and go. Okay.
Is it Erica on here?
I think she's on here. Erica Pearson is my wife. She also works with me in the business, and she's been an agent with Brian for 2.5 years, I think.
Yeah, something like that. She's the one
Yeah,
who
something like that.
introduced me to you. I had a loan officer before who she was good, but she just was overburdened at that time, and Erica introduced me to you, and so it's been really great.
Okay. So I know right now with the industry and everything, everybody's got lots of questions about what's going on with the mortgage industry. Right now, you're hearing about companies laying off hundreds and thousands of people. You're hearing about companies actually closing. Sprout Mortgage, which was a wholesaler that did a lot of bank statement type deals, stuff that wasn't regular conforming. They shuttered yesterday. They shut their doors. They had, I believe it was 600 employees, and that's actually a Texas-based company. And what's going on is that these companies that you're seeing that are laying off thousands of people or hundreds of people, what's going on is they were in the business for years, but what they did is they ramped up when rates fell, and they started doing primarily just refinances. And there's a business model for that, because what they do is they make a lot of money, and it's a cash grab. The problem with that cash grab is as soon as rates start to move back up, which historically, this is a cycle. We're in an industry. You'll see rates go down, you'll see rates rise. But when rates rise back up, they can't do the refis like they were doing. And that's what we're starting to see now. I've got a list of some of the volume for some of the bigger mortgage companies in the last 14 months. And if you look like Rocket Mortgage, they did $403 billion in business in the last 14 months, but 88% of that was refinances. Doing that number of refinances, as you can see, they made great money for the last 14 months, but now that rates have started to go up, the refi business is down to where we're doing about 5% of what we were doing before. So you've got all these big companies, they've got to lay off people. They hired loan officers, they hired support staff to close these loans, but now you're hearing about these layoffs, and what the media doesn't tell you is that it was 100% a cash grab. They made lots of money. I interviewed a loan officer yesterday that wanted to talk to me about coming and working for me. She was working for one of these bigger companies. In the last 12 months, she closed 244 loans. To close 244 loans, she actually disclosed to me on her W-2, she made $140,000. She was making on average like $600 a loan, which is almost no pay whatsoever, but they were providing the leads. They were running these YouTube ads, they were running these Google ads.
Here's the
And so they're just pumping these customers as quick as they can get them. But the problem with that is that the business model is not sustainable. If you look at these companies, all these companies, more than 50% of their business was refis. Now that rates are back up, you're going to see these companies lay off massive amounts of people because they can't support. They don't need the staff, they don't need the underwriters, they don't need the processors, because now their business is going to fall back down to a normal, purchase business. Because to stay in the mortgage industry, my slides are not switching. I apologize. I just realized that. Let me see here.
Hey guys, we can also get you a copy of this slide deck after we're all
Yeah,
set.
here we go. I apologize. I just realized that it wasn't switching on your side. So these are some of the bigger companies. I'm pretty sure we've all heard about Better Mortgage. This is the CEO that laid off 600 people in a Zoom meeting. But here you go. As you can see, these guys, they were doing massive amounts of refi business. And I mean, everybody knows Rocket Mortgage is one of the bigger companies, because if you look at this guy here, 88% of their $403 billion was all refi. It was an unsustainable business model, but they made a lot of money in the interim while they're doing it. These loan officers, the reason that you don't get the kind of service you're going to get from a loan officer like myself is these loan officers, they make on average $500 or $600 per loan. So you're not going to get that, oh, let me hold your hand and walk you to the end, because for them to make any kind of real money, they've got to close so many loans in a month. If I had to close 24 loans a month and it was just myself, I wouldn't have time to do anything else. And these guys, they don't have loan officers assistants and stuff like that, because the companies are set up to make all of the money on the back end. They're going to make a lot of money. They're going to pay their underwriters and their processors and their loan officers very little. And so right now, for me, and when we moved over to primary at the beginning of January, before the market started to truly crash and the rates started to raise, finding a processor was impossible because they were all employed. Now I get 5 or 6 resumes a week from processors looking for jobs, from underwriters looking for new companies, because they're being laid off by all these bigger companies. Now we'll talk a little bit about interest rates. I apologize, I'm having some technical difficulties on this. Give me 1 second.
Real quick.
All right.
Oh, you're good?
Okay, there we go. I got it. Interest rates, since January, it was early January or end of December when the Feds announced that they were going to stop suppressing rates. They had been suppressing rates since COVID started to spur the economy, to get us through, the historic amount of unemployment. Since then, we've seen rates rise. The good news, in the last 2 weeks, rates have dropped just a little bit, but if you go look at the historic numbers, this is a historic average 30-year rate. Now, keep in mind, this numbers that I pulled, this is based on putting 20% down for a credit borrower. But if you look at the rates right now are historically low still. I mean, I got in the mortgage business in the early 90s. And when I got into business, rates were in the 10, 9, 8.39. So even though rates today, I think our average is right around 6%, they're still not anywhere near the historic highs. If you go back and look in the, 70s and 80s, this is what a 30-year fixed home, if you wanted to buy a home, you were going to pay somewhere between 8 to 10% on the rate. And there was a couple years in there where rates were in the 16% range. Now, so what I tell people when dealing with rate is, first things first, if they're on Zillow, if they're on Google, if they see rates advertised there, you have to remember a lot of mortgage companies advertise teaser rates. Those rates are usually based on you putting 20 to 25% down. They're based on you having credit scores of 780 or higher. The average American does not have a 780 credit score. So you've got to remember that the best thing to do is get with a loan officer that knows the business, that understands the business, and get them to quote your customer based on their actual situation. A lot of people don't have 20% to put down. And so I just tell them, I said, you got to look at it from the standpoint of, with the appreciation that we're seeing in the market, especially if you're in Texas and one of the major metropolitan areas, we're seeing, somewhere between 18 to 24% appreciation a year right now. Now we do anticipate that to slow down because of the higher rates, because of the outlook with interest rates and the inflation, but we're still in Texas. It's going to slow down, but we're not going to see values to start to decrease, especially if you're in one of the major metropolitan areas like DFW, Houston, where our job market is very strong. So it's one of the things that real estate is still one of the best things that you can invest in. And part of being able to invest in it is being able to get a loan. So I encourage you to have me take a look at your deals, have me take a look at somebody if they've been turned down someplace else. I still would like to take a look at it and see if they didn't have the amount of experience that I had. I can tell you the one that I pre-qualified for Sherry yesterday, brand new loan officer would have just told them, hey, you need another year's tax returns. But I knew because they were related field, she had just graduated and passed the bar, that I could loop that all together. It took me an extra day and a half to get it pre-qualified because I had to get it sent over to an underwriter, get an underwriter to sign off and say, hey, yeah, this makes sense. And then I sent out a pre-qual. Now they can go out and start looking for a house. So my takeaway from this for you would be, don't let the interest rate scare you or your customers, because real estate still is a great investment. Let's see here, next slide. Another thing too is you got to remember with the rising prices, the supply and demand. When the economy crashed early during COVID, the Federal Reserve forced interest rates down. They wanted to keep money circulating. They announced early December they're not going to do it anymore. They're not going to do. They said that they were going to raise interest rates 0.5% every quarter this year. And last quarter, instead of doing a 0.5% raise, they actually hiked the rate 0.75. We don't know what they're going to do, but they have said that we're looking at a 0.5% increase every quarter this year. So more than likely, we're going to see rates rise just a little bit. But there again, we've got to stay in the market. We've got to stay, moving forward. I'm still sending out pre-quals. I'll be honest, since rates have risen, my pre-quals are probably down about 30% because some people don't qualify. But with those people, I always break down to them what they need to change. We have a lot of people, especially in the major areas in Texas, they have super high car payments. Before I started doing business in Texas 5 years ago, I almost never seen a car payment that was $1,200 or $1,300. Now you see them a lot. I mean, you got teachers making $65,000 a year and they've got $1,300 car payments. And then if they're married, you've got husband and wife of those kind of car payments. So it makes it harder to get them qualified. But like I said, if you get them with my team, we'll take a look, and we can always structure loans where maybe just the husband or the wife is on the loan, and we can usually get them pre-qualified or have them come up with a game plan so they can get ready to purchase a house. Now, a little bit about my team. We're a full service branch. I can do your, A loans. Those are easy loans anybody can do. But we also do offer some things here with my branch that a lot of other places avoid doing. We specialize in doing down payment assistance. I know if you talk to a lot of lenders, the down payment assistance programs get a bad rap. Many lenders tell you that they're hard to do, that they take a long time in underwriting. I've heard people tell me, oh, those loans take 45 to 60 days. Well, here at Primary Residential, we're delegated with two of the top down payment assistance lenders. What that means is my underwriters underwrite them in-house. We don't have to send them over for a second look. So I can still close down payment assistance loans, and typically we can close them in 25 to 35 days. The hardest part for these loans for us are still getting appraisals. A lot of the rural areas in Texas, we'll see where we'll order an appraisal and it'll tell us it'll be 14 to 21 days to get back. But if you're trying to do a DPA or a down payment assistance loan in one of the major metropolitan areas, we can still close them in under 30 days. The good thing about the down payment assistance is it stops the customer from having to clean out their savings account. Or I know that, Brian, you have a lot of agents to deal with rentals. If you've got a renter that's been renting with you and they say, hey, I'd like to buy a house, or we're thinking about it, and rather than you lose that business, you can always say, hey, let's get you over with Anthony. Let's see if you qualify for one of the grant programs. The good thing about our grant programs is typically to buy a $300,000 house, if you're going to put down your minimum of 3% or 3.5%, you're going to need with closing costs somewhere around $18,000 to $21,000. With the DPA programs, I can get that same person into a house, and instead of needing $18,000 to $21,000, we're going to see where they need $6,000 to $8,000 because the grant will put in the difference. I always see if I can get them approved on one of the grant programs that are fully forgivable. There's two big ones in the state of Texas, which is TASAC or TDACA. They both have 36-month forgivable programs where they get qualified, they move into the house, they get the grant, and as long as they stay in that house for 36 months, make their mortgage payments on time, then the grant is fully forgiven. Now, the funny thing is with the appreciation and stuff, I've got quite a few, probably 15 to 20% of my people that I closed 2 years ago, they've either refinanced or sold their house. I have one gentleman in McKinney, he bought the house for $260,000, and I think Eric had just put the house on the market for $430,000, $425,000, $430,000. And this gentleman, when I helped him, he was on the fence. He was like, I don't know, maybe I should save more money. But if you talk to the gentleman today, he's sitting on somewhere between $85,000 and $125,000 in equity. During COVID, he actually lost his job. He had his mortgage go into forbearance. So in 2 years, he had 9 months where he didn't even make mortgage payments because of the COVID relief that the feds put in. His credit still is perfect because they couldn't report him late. And now he's looking at selling his house and he's going to cash out $100,000. That's with him having to pay out back the down payment grant. So there's times where people don't get to the forgivable part of these grants. But this gentleman, if you talk to him, he would tell you, hey, buying this house and using this grant was one of the best things I've ever did because I'm going to cash out, close to $100,000, and I lived in the house for 2 years. So I encourage you to don't think of all the negative stereotypes that you hear about the down payment assistance. I'd love to look at any of your clients that are thinking they want to buy a house and that they would like to get some grant money, because we can always take a look. And I approach any loan the same way. I look at it as a holistic approach, and I go over with your customer, this is what you need to be pre-qualified, or we get them pre-qualified, send you over a copy, and you guys get out and look. Here's my contact information. And if any of you would like to set up a time to talk more about the programs that I have, I'd encourage you to give me a call or shoot me over an email, and I'll put you on my schedule and we can have a quick 10-minute chat, go over the different programs that I have. And any mortgage related questions you have, I always encourage you to reach out. You can call or text me. I answer my phone 7 days a week. To date, I have a little over 125, 130 people pre-qualified looking for houses. I figure payments for your customers, all of that stuff. You know, I had an agent call me on a contract Sunday. And when I picked up my phone, the agent paused and he says, "Oh, I wasn't expecting to talk to a real person. I just wanted to find out if your customer," and he literally had to put me on hold to go find the customer's name because he was planning just to leave a voicemail, because most lenders do not answer their phone during the weekends because, you know, oh, they're out enjoying their time off. I answer my phone Fridays and Saturdays. Now, I'm not going to be working on Fridays and Saturdays for 10 or 12 hours, but if you call me in the middle of the day on Friday or Saturdays or text me, you're going to get a call back or a text back letting you know, hey, I'm not available now, but I'll talk to you in an hour or two. So I like try to make myself available to all my agents and my customers 7 days a week. And any questions that you guys have? I think, Brian, if you can unmute.
Yeah.
them.
Yeah, let me jump in there first. So yeah, guys, so he actually wrote the loan on my house that I'm living in now, back in September of 20. And it was funny because this was right whenever things were starting to get crazy, like houses were flying off the market. It was just the beginnings of it. But I wanted to make, a really sweet offer. And so we put in, no contingencies, fast close, all of that. And Anthony actually had me approved, and I think it was 13 days, something like that, like ready to close in less than 2 weeks. I know that doesn't always happen like that, but I was pretty shocked whenever he came back saying, hey, we're ready to go, less than 2 weeks later. I think all the stars were aligned. I mean, it was definitely a God thing, but it was really cool. And that was near the beginning of us, working together. And since then I've sent him my pastor and his son, and several other people have, gone on to use him and his down payment assistance program. And they've been able to get homes that they otherwise couldn't afford, and since appreciated, like he had said. One of the things I wanted to kind of point out from your presentation is during the 80s, whenever it was up in the teens, that was during the whole Reaganomics era, where Reagan, his platform promise to becoming president was to get rid of record high inflation at that time. I mean, inflation was out of control. And so they knew that, raising interest rates was the way to do it. But he went a little overboard with it, raised the interest rates incredibly high, and put the economy into a deep, deep recession for the late part of the 80s. As a matter of fact, those of you who have done apartment locating, you may have noticed that there's a lot of apartments in the early 80s that were built in the early 80s, but like the mid to late 80s, there's hardly any at all. You won't see them. And that's because the economy had basically crashed and interest rates were way too high. And there was no more construction of apartment buildings for a very long period of time until you got into the 90s, where the market started to recover. Now, I don't think that we're going to get to the same location there. I don't think they're going to raise interest up so much that it puts us into that kind of economy, but I do think that they are going to raise it. I wanted to ask you, Anthony, where do you think that interest rates are going to land? And as far as like the high water mark, what do you think it'll be, and when do you think that might be?
I think I have a sneaking suspicion that the Feds are going to stop raising rates. I think that this quarter coming up, that we might see another 0.5% raise. But keep in mind, the lenders, when you tell us at the beginning of the year, hey, we're going to raise interest rates 0.5% every quarter for this year, the lenders, they do not wait. My back office that deals with rates, they started cooking in that raise weeks, even a month before they know it's coming, because you have to remember the cycle of a loan. When I go in and lock a loan, that lock is usually for a minimum of 30 days, and it can be as long as 60 days. Well, we don't go out and get the money that day and say, hey, we've got a lock on this loan. as a lender, we've got to have the pricing built in. So if it's 45 days before we close that loan, it's 45 days before that loan can be sold. So if we're locking a loan today and we know that anticipated that, a month and a half from now, rates are going to be 0.5% higher, they're building in that into the rate that you're seeing today because they know that that loan isn't going to be ready to sell for 45 to 60 days. So one of the things you have to keep in mind is the rates that you're seeing today, the lenders have already started to build in knowing that the cycle is 30 to 45 days from the day that we see a lock to close. So they're already building in the rate now.
They're padding the
So my
numbers.
thinking suspicion is I think we're going to see probably one more quarter where we get a raise. And I think by the end of the year, they're going to stop raising rates again, because if I go back to this page, let me get that pulled up. If you look at rates right before COVID in 2019 and 2018, let's see, can I get you back to this page? If you look at rates here, right now, for this year, the average has been 2.96. Now keep in mind, there's only a few months in there, but if you look at right before COVID started in 2019, rates were here. Right now, I think when I pulled this morning, the rate was 5.84. I think we're going to land and we'll see rates settle right under 6%, and they're probably going to stay there till election. Now, rates will trickle a little bit, but I don't think we're going to get anywhere where we're going to see 7, 8, 9%. I think we're going to settle in this 5.8 to 6.5% range. This is the second week where rates have ended down. So I think we're going to see it settle, and we're probably going to see some rates like we're seeing. If you look at the 2005, 4, 5, 6, I think we're going to see rates right there for the next couple of years until election year. And then with election years, typically you'll see rates start to trickle down, because that's usually one of the platforms that they like to run on. Or you can have a president take the other route of saying we're going to fix inflation. But I think with the way the media is today and everything, I think we're going to see rates pretty much stay right about where they are now, maybe go up 1/4 to 1/2 point. But I don't think we're going to see rates get much higher than where they are in the mid-6s. And keep in mind, the rates you're looking at here, this is based on you putting 20% down and having an excellent credit score. With 3 or 4 or 5% down, you're going to see the rate be about 0.5% higher. So I think we're going to settle.
Isn't there a different rate for the down payment and also commercial loans as well?
Yeah, commercial loans they work off a totally different rate. Commercial loans right now, I don't know. I didn't pull the rates on that, but typically you're going to see those rates be about 0.5% higher than what you see the 30-year rate. And also with commercial loans, it depends on the risk, because the bigger the project, the more risk the bank is taking, because instead of asking for $100,000, you're asking for 24, 25, $30 million. So there's a risk factor that they build into that too.
In the down payment, isn't there a higher rate for those as well?
For what was that?
The down payment assistance programs?
Yeah, down payment assistance typically, well, here I can go look at the DPA rates for you today. And then another thing too, if you start working with me, I always encourage you guys to go like TASAC. If you go to their website and go to lender and hit today's rates, they publish them every day. And if you look here, this is the 3-year deferred forgivable. We put about 90% of our clients on this. This program over here, this grant, it's got a 6-month forgivable, but to get qualified for this grant program, I have to have 3 years of full tax returns. And if mom had a side business where she was selling something on Etsy, if one of them is a part-time realtor, if they show any kind of loss on their tax returns, we have to take that away from W-2 income. If we go with this program, if they're W-2 employees, I don't even need to look at their tax returns. And as you can see, this one only offers 2% in assistance, and the rate is 6.75. Now, this one is forgivable in 6 months, but if they get on the 3-year forgivable, for 6.75, they can get 3% in assistance, and the rate is still lower, because this loan is more profitable to them because they know you're going to keep it for that 3-year period, or you have to give them the grant back that they gave them. So about 95% of my customers close on this one here, because rates are typically cheaper. Like here, if they take 2% in assistance, 6.125, compared to 6.750. And with this program up here, I need 3 years full tax returns. And most people have some type of side business, side hustle. They drive Uber, they drive Lyft, they do DoorDash. And all of those jobs, when you put them on your tax returns, you lose money. Once you write off the mileage, once you write off the cost for keeping your car up, they typically do not make money. And that would make you qualify for less house, because once the underwriter sees the 3 years tax returns, any losses he has to take out of your current income. And that's why most of my customers go on this plan, because if you're a W-2 employee, I just need 2 years W-2s and a current pay stub to get you qualified for this program. We don't need your tax returns. And that's one of the biggest mistakes that people make when they're writing these grant loans, is they try to put them on the 6-month forgivable one. And I can tell you, probably 50% of my customers would not qualify if I went and looked at 3 years tax returns. And I know that because up front, I asked them for 3 years tax returns, take a look at them. And a lot of people, especially through COVID, came up with side hustles. And those side hustles, when they report them on their taxes, they show them as losses. So that's why when we're underwriting them here, we come and we look at the rates on the 3-year forgivable. And typically they're cheaper. A lot of times this one, like 675, and this will be a 0.5% higher. So it'd be 7.25 for 3% if it was offered today. Whereas I can get you 6.625 and still get you the 3% to cover your down payment for FHA or for conventional minimal down.
Great. Okay.
Okay.
That answers my question. Anthony, Adam had put in the chat, he said he's seen companies convert offers into cash offers, and he was asking if you had any experience with those. I don't think those are mortgage companies. I think
those aren't mortgage companies. There's a couple of big companies out there that do that. The positive about it is it gives you the ability to make a cash offer. The negatives is there's a fee. We just did one with, if you want to know the name of the company, I can find it for you. We just closed one with, and the woman, she ended up paying that company 1% of her loan amount for using their cash option. And that company, the way it worked is they made the offer as a cash offer. I had 30 days to get the financing done. If we weren't ready to close in 30 days, they would come in and close with cash, and then she could still secure the financing through me. And I want to say she spent 1%, but even though I closed her on time, they still got their 1% fee because they were prepared to pay cash for the house. So you've got to look at it from the standpoint of your borrower. If you're buying a $300,000 house and you want to use a company like that, if they charge a 1% fee at closing, she needed to have her closing costs, her down payment, and she still had to pay them their 1% charge, even though they didn't even use her money because the way they wrote the contract. But there are a couple of companies out there, and if you'd like, I've closed with a couple. I could dig out the information, and if you want to contact me, we could go over it, and I could give you the information if that's something that you want to get more information on.
Great.
Contact information.
Anybody else have any questions? If you're not able to unmute yourself, let me know, because I did mute several people. Just put it in the chat box or something.
Anthony, this is William from San Antonio. Do you have any capabilities for construction loans, for new home construction loans?
No, primarily we don't have a construction loan division set up, but if you do have a borrower for construction loan, I can always get you a referral. I worked for Gateway First Bank for a number of years. They have a really big construction loan division. They're a local bank. Well, they're actually in Oklahoma. Their home office is in Oklahoma, but they do construction loans. The thing about construction loans, I've done them. They're a total different kind of animal. They're hard to get closed. They're looking for more than, you need to have a higher credit score for them. But if you need a referral for a loan officer that can get you a construction loan, I can definitely get you with somebody.
Yeah, if you can do that. I have my son's just trying to find one to build a home. So
yeah, take down my information and text me or call me after this, and I'll get you a loan officer at Gateway. I'll ask you a couple questions to make sure that his, credit. Construction loans are hard because just to give you an idea, I've done mortgages in several different states. I had two, I was a broker in New Mexico. And to be honest with you, it was way easier in New Mexico to get a construction loan because the state of New Mexico had licensing for builders. The state of Texas does not. And so the reason that it's so hard to find construction loans in Texas is because no builder is licensed here. Brian tomorrow could decide he wants to be a builder, print some cards up and go out and say, hey, I'm building houses. There's no licensing. And from a lender standpoint, in a state with no licensing, the risk is so much higher. So here in the state of Texas, to get a construction loan, they want to see you have somewhere between 10 to 20% invested in the deal. They want to see your credit scores of 760 or higher. And they have big contingencies because with the builder not being licensed, you pick a person to build your house and they don't do it, the lender is on the hook for the money that they've already given them, or they have to finish having that house built. And that's why in Texas, construction loans are so much harder to find banks that will do them, because the state of Texas does not license builders.
Now there's some big box builders. Oh, our country, they
Right.
do new build, but what they said is that the clients actually take out a construction loan. So they're more or less just selling a lot, and they have all the contractors, on call and everything, but they actually want the buyer to take out a construction loan and front all the money for the build.
Yep.
What is that any different, or is it still the same whenever you have a big builder like that?
It's the exact same because there's nobody licensing them. So the lender's risk is we start letting you build this house. We give you the 20%, they go out, they start. If the builder walks away when the house is halfway done, there's no licensing from the state. So this guy can go set up ABC building now is XYZ building. He's building, taking deposits and doing this again. But there's no one to hold their foot to the flame to say, hey, you've got to finish this house or we're going to come after you. You're not going to be licensed in the state because there's no licensing. And that's why any of the builders that say, hey, we'll build this house for you custom, but we'll let you close once it's built, that's an easy loan because the lender has no risk. When you say, hey, we want to use this builder, and let's say it's ABC builders, unless the lender's done a build job with them before, they have no way to know if this builder is reputable. I can tell you what Gateway had you actually sign a form saying you realize you were responsible for the builder, and if they failed to complete the project, that you were responsible for finding someone that could complete the project. And that's one of the things I can tell you. Gateway, they're very strict with releasing money, and they have an inspection that has to happen before they'll release additional funds. And they were very strict about it because there's no licensing. I think the only construction industry in the state of Texas that licensed is plumbing, electrical, and HVAC, and I believe roofing contractors. Everybody else, there's no licensing for the whole state. And that's the problem with lenders when we look at it. We can't keep a list of approved builders because anybody can be a builder. So when you reach out to lenders, you always can ask them if they have a list of builders that are approved with them, because if they do, then you can use that builder in it's going to be less strict because, like Gateway, if they've got a builder that's got on their approved list and they've done 9 homes in the last year, they know this guy finishes homes. So now the overall, they have overlays, like you have to have a high credit score. You can't buy a build job with minimum down. I think Gateway, their minimum they'll let you have invested in it is 10%. But on top of that 10%, you have to have 12 months of principal and interest. Basically, your final payment, you have to have at least 12 months in reserves after you pay the 10% down before they'll even let you move forward and start the build job. So it's just one of those things that's a little bit harder to get qualified for. Now, if you're dealing with a builder like D.R. Horton, Lemire, one of these builders where they build the house and you just buy it once it's built, the lenders don't mind that because there's no risk. We're not putting any money in to get the build done. But when you're trying a construction loan, you have to remember you're asking the lender to pay somebody that there's no way other than by us doing a little bit of research, seeing if they have I know Gateway, they checked for commercial licensing. They checked for commercial insurance. There's a whole bunch they have to do to make sure that this guy has the bonds and stuff in place for the lender to get the money. But it's not an easy thing. And I always tell people, if you're going to do a build job, if you can figure out how to get the house built and then just do the mortgage on it after it's done, it's way easier than dealing with the builder. And I can tell you, being at Gateway, I think we did probably 10 to 12 construction loans the 2.5 years that the branch I was at. And out of the 12, I think it was like 4 of them, the jobs never got done because of builder issues, or they had to go find another builder. And they just turn into nightmares when all of a sudden, you're like, you go to check on your house and you're like, hey, nobody's been out here working on this. Then you've got to call the lender and let them know, hey, my builder's disappeared. So
Ugh.
you want to be very careful with construction loans and builders, and make sure that when you pick a builder, get references. If you can talk to the references, and I've even had agents go so far as to tell me that the builder invited them to come out and look at jobs that they were working on now, because you want to make sure that you're dealing with a reputable builder. Because if not, when everything hits the fan, the lender, you're on the hook just as much as the lender, because the lender, when they evaluate a job that's not finished, if it's not far enough, there's times where the lender will just say, we'll take the land and we're going to get rid of that. We won't finish the house, because lenders aren't in the job of building houses and they don't want to take on that. Another one, we had one of the build jobs I was working on, after the house was built, there was some issues with foundation issues, and the house was like 1.5 years old. And it was the branch manager that I was working for. And when everything was done and said, the lender, we have no way to fix that foundation for you. You pick the builder, because I can tell you, Gateway won't even give you a list of approved builders, because they don't want the liability of saying, hey, I picked one of these 5 guys because you told me they were legitimate.
So maybe finding a builder and then seeing if they have any lenders that they've worked with. Do you think that would work?
Exactly. Local banks are the ones. And if you're dealing with a builder that builds, an average builder, just a small one, he's going to build somewhere between 10 to 12 houses a year. More than likely, they've already established a relationship with a local bank. And that's where you're going to get your best rates and the least amount of work to get this loan. Dealing with a lender, it's so much harder. And the sad part about it is, when I did these in New Mexico, I did construction loans all the time, because New Mexico licensed the builders. And if they messed up, they'd lose their license. And it wasn't a matter of, oh, I'll just go start another company, because the person had to be bonded, they had to be fingerprinted, they had to be this. So this person could never get another builder license if he lost his license.
Yeah,
And
I wish they had that here in Texas.
Yeah, that would make this so much easier from a lending standpoint, because then you'd have lenders come in and all they do is construction loans. I don't think we have lenders in Texas that just do construction loans, but in states where there's builders licensing, there's companies set up and all they do is construction loans. Yeah. Because it's a specialty product, and if you know how to do it, you can do it well. But they won't deal with states that don't have licensing for builders, because there's no way for them to ever come after somebody and see that, hey, we're never gonna have to run into this guy again. Yeah, it's so that's a little bit about construction loans. Okay. But there are lenders out there. Local banks are usually your easiest ones to get them done at. And if you're dealing with a builder that's reputable, that's doing his 10 to 12 houses a year, he should be able to send you in the direction of, oh, we've worked with XYZ Bank 4 or 5 times in the last year, and those are the guys that are going to be easy. The loans are approved with. But new builds, if you don't have a 740 FICO, I don't know of any lenders in the state of Texas that will even look at you. I know at Gateway with a 740, you had to be putting 20%. You had to have 20% invested. If your FICO was above 780, you could get away with 10%.
Well, we got about 5 minutes left. Does anybody have another question? Anybody? Bueller? Okay. I will get a copy of the slide deck from Anthony, and I'll send it out to those of you who requested it. And if you do want a copy of it, go ahead and just shoot me an email, and I will get that over to you. And we'll go ahead and just wrap it up, since no one else has any questions. If you think of something later, feel free to reach out to me, or his Anthony's contact info is on the screen there. You're welcome to reach out to him directly. I will personally attest he's a great loan officer. He's very helpful, and he's gotten a lot of deals done for me. So if you guys need help in the lending area, definitely give him a call. All right, y'all have a blessed day, and we'll have a good weekend. Okay.
Thanks, guys.
All right. You guys have a good weekend. Thank you, Brian.